This is your macroeconomics video on the discount rate. Of the three tools that we are learning that the Federal Reserve can use to affect the money supply, the discount rate is the third one. The discount rate is also sometimes referred to as the prime credit rate. It is the interest rate on loans that banks can borrow directly from the Federal Reserve. So you are a customer of the bank, but the bank can be a customer of the Federal Reserve. Individuals and consumers cannot borrow money directly from the Fed, but banks can. And when they do, they borrow money at the discount rate. The Federal Reserve can, of course, control whether the discount rate is high or low. If the discount rate is very low or close to zero, it encourages banks to take free money from the government at a really low interest rate. The minute that the money that you've borrowed from the Fed hits your private bank, you of course have to have excess reserves. You can loan more out, and thus you can get more money to loan out and make profit. The higher the discount rate is, the less likely banks would borrow money to add money to their private banks. A lot of times banks do not want to borrow money from the Fed, because in a private banking system, if your customers were to find out that you were not doing so well and you needed to get a bailout from the government, it can look like you're not managing your money very well, which of course is the plan of a bank, and that's why they're in the banking system. So you don't want your customers to find out that you have to get a bailout from the government. Because if your customers don't like that and they start to worry that you don't understand how to finance their money, then suddenly you could get a run on the bank. But from time to time, banks are running super low on reserves. They have the option that they can borrow money from a competitor bank, or they can borrow money from the government. They typically prefer on a regular basis to borrow from a competitor bank. We're going to talk about that in another video. But when recessions come around, or pandemics, or things that affect the entire economy, it could be that all of the banks are having trouble getting people to pay off their loans or getting people to deposit money into the bank in the form of savings. So when that happens, the Federal Reserve can lower the discount rate. This would encourage all of the banks to take some very low interest money from the government. They can use it to kind of beef up the money supply in the banks. This, of course, you still apply the required reserve percentage to this, but it still gives you some extra money you can loan out and try to make profit off of it. So by lowering the discount rate, you encourage banks to borrow more money. This would increase the money supply that's in the banking system. That lowers the interest rate. And when the interest rates are lower, it encourages people to go to the banks, borrow money, and spend, which increases aggregate demand. If you wanted to reduce the money supply, the Federal Reserve could raise the discount rate. That discourages banks from borrowing. And of course, if they had to, they would be paying a lot more interest. So they generally don't want to do this. The Fed typically uses this when they need extra liquidity in the banking system, when financial institutions as a whole are in trouble, or there's some type of really large banking system problem, like a banking or mortgage-backed issue with a recession.